Mario, what's up you guys? It's Roy, it's Jacob. Welcome back to the channel. In this video, we are going to be focusing on two things. The first of which is why we are not yet in an economic recession and why it's unlikely that we'll see one for quite some time in the case that we do. And the second is why I'm exceptionally bullish on small caps and growth stocks in this current market environment. If you guys have been tuned into the channel lately, then you know that I think the markets across the board are due for some extended relief and upside as we progress through the month of June. But growth stocks specifically, and I do have some charts to back this up, are historically undervalued and are looking exceptionally appealing to me as a trader. Okay, so hopefully you guys gain some value from this. We will go over each of the topics that I want to share with you guys and read over before diving into them individually. But before you do that, please let me know in the comments down below, do you think a recession is on the horizon or not, and why? Okay, so looking forward to seeing your responses down in the comments. On top of that, I do have to address this, you guys. The shades have finally changed for the first time in 2 years. Also took some brand new clickbaity thumbnail pictures as well yesterday, which you guys will be seeing for the first time in this video. And it feels good, you guys. Change is a good thing. Change is necessary, okay? It's necessary to grow. And it does feel good to change. The portfolio, the newsletter has seen a real reawakening over the past month. May was actually an amazing month, regardless of how kind of dismal the market environment was. But for the portfolio, the waste portfolio thrived during the month of May. I'm very bullish on it going through the summer. And hey, we are officially in the second half of 2022, and I figured it was about time to change up the look and feel of the channel. So again, you guys, cheers to change. Change is a good thing if applied correctly, and I'm excited and very appreciative to go through the second half of the year with you guys. And hey, let me know what you guys think of these. If they're stupid, if you hate them, let me know in the comments down below as well. You can feel free to roast me. Okay, so let's go over the topics. Let's go over the subject matter, and then we'll dive into each one individually. We got a decent amount of reading to do today, but I do think it's all relevant. I do think it's all pretty, obviously, I spent a lot of time prepping this morning, actually. So yeah, just sit back, relax, go grab a drink, and yeah, cheers to that as well. So the first thing we are going to be reading through is this. So we're going to be focusing on growth stocks first, because this is a little bit of a longer read, talking about why an economic recession is likely. We do cover a few points on that note as well in this first article, but we'll kick it off with the growth stocks, and then we'll close it out with this article talking about recession, but I'll talk about that a little after. Okay, so first article, regardless, is CNBC Pro, titled JP Morgan's Kolanovic sees stock market recouping 2022 losses and ending the year flat. Okay, so this guy, very reputable analyst, very reputable trader. You will learn more about him as we read through this article, but he is also very bullish, like I have been. And again, if you guys have been watching lately, you know why this is. Think there's attractive risk reward, say that specifically on cyclicals, growth stocks, and small cap stocks. Okay, so pretty much everything we talk about, at least the plays that we prefer here in the Waves fam. Okay, so again, we'll talk about this, talk about why he, unlike many others, I should say, thinks that a recession is unlikely in the near future, and why he's bullish on growth stocks and small caps. Okay, to supplement the growth stock argument, we will also look over a few charts from what I believe is probably the best, the best under the surface analyst in the game, or research group in the game, which is Yardeni Research. Definitely go check out yardeni.com. You can just see the domain right there. But we'll take a look at the S&P 500 large cap, S&P 400 mid cap, and the S&P 600 small cap to reinforce the bullish sentiment on growth stocks versus large or small cap stocks, I should say. Growth stocks, hyper growth stocks, small caps, same thing, tomato, tomato. But why they are historically very, very oversold and undervalued, more so undervalued relative to large caps, by taking a look at historical PE or price to earnings ratios. Okay, so we'll talk about that after we read through this guy. Maybe between those, I do want to reference this. So this is what I opened up the video with. As you can see, this is Monsieur Jamie Dimon. He is the CEO of JP Morgan Chase. Very, very, he's in if you guys are in the markets, you probably know who this guy is. But he said, he was all over the media this morning. Jamie Dimon says, brace yourself for an economic hurricane caused by the Fed and Ukraine war. And I do want to discuss this. This is a screenshot that I included in this morning's newsletter. So I do want to go over a few metrics that I included in this morning's newsletter, fear and greed, bull bear index, and talk to you guys about why I still think this market is overly fearful and why I do still believe that the majority of potential macroeconomic headwinds are already priced into the market. Because again, the markets are hyper efficient at pricing in future economic complications. Okay, so I'll read over these guys once again to close out the video. We will take a look at whether or not we are in a recession. This guy says no. This is written by Barry Ritholtz of The Big Picture. And I just randomly stumbled. I've just so many freaking newsletter subscriptions that I research every morning prior to writing my newsletter, of course. But this guy says no, Barry Ritholtz, and I actually really enjoyed this little write-up. It was kind of abstract, which you guys will see why that is. But are we in a recession? No. I want to read over this with you guys and kind of expand on some of these points wherever I feel necessary. Okay, so that is the breakdown of the video. Again, let me know in the comments down below, especially after listening to this. Do you think a recession is on the horizon or not? And hey, let me know if your opinion changed after watching this video. And again, feel free to roast the new glasses and roast the thumbnail pictures. Okay, so let's read over this again. Attractive risk reward in cyclicals, growth stocks, and small cap stocks. Wall Street strategist Marko Kolanovic said he's staying optimistic amid the market volatility, calling for the S&P 500 to recoup this year's steep losses and finish 2022 unchanged. Quote, we remain positive on risky assets due to near record low positioning, bearish sentiment, and our view that there will be no recession given supports from U.S. consumers, global post-COVID reopening, and China stimulus and recovery. And again, you guys, China, Beijing, Shanghai did just recently reopen, and that is very, very good for the global economy. The strategist believes the markets have already priced in the tighter monetary policy from the Fed, adding that inflation may have peaked. Despite the steep sell-off, quotes, we believe the markets will recover year-to-date losses and result in a broadly unchanged year. This is now an out of consensus bullish view, with most strategists now negative, Kolanovic said. The S&P 500 has fallen more than 14% this year as the Fed started to aggressively hike interest rates to combat an inflation at 40-year highs. The equity benchmark also briefly dipped into bear market territory on an intraday basis last month before bouncing back a bit. JP Morgan's Kolanovic was one of the few on Wall Street who correctly called the March 2020 bottom and the subsequent rebound. He was promoted to chief global market strategist from the bank's head of macro, quantitative, and derivative strategies in 2021, which for JP Morgan Chase, again, arguably the largest and most prominent, just most legendary investment bank in the world. And that's why Jamie Dimon is such is a Mount Rushmore of this industry. And it's also funny how these two went head to head today. And I do recommend you guys go check out this video on CNBC and listen to this, because he did talk about how Jamie Dimon, what he said wasn't wrong. But again, he's breaking down kind of the time horizons. And it was, again, I'm reading you some of the highlights, but you should go watch this video for yourself. Hopefully after this, go watch it now if you want. Whatever, but you should go watch this at some point. Okay, so again, this guy successfully called the 2020 bottom and rebound. And the strategist said some segments in the market are now trading at all-time lows relative to valuations. Again, we'll take a look at that here, including innovation-focused companies, China ADR, small caps, and biotech. Kolanovic said the most attractive investment opportunities are in these oversold sectors that provide asymmetric upside. So if you guys have been around for a long time, one of the videos that's kind of evergreen for me, one of my few evergreen videos, which means that people are still watching it to this day, is talking about how to take profits and not be greedy. And in that video, I talk about my trading strategy, which is still the same to this day, and that is looking for stocks. And these are in how I made 50K in a week, 470K in a week too, okay, or 50K in a day, etc. You guys know those. Always talk about asymmetric risk profile. That means that when you take the data available to you, okay, and as a trader, you take all of the data sets available, you take all of these indicators, all of the charts that we're looking at, fundamentals, technicals, into account, and you use that data to skew the odds in your favor and weigh out the risk reward profile. Okay, if you're taking a 60-40, if you're taking a 70-30 bet where you've analyzed the data and you think you have a 70-30 shot, you take those shots 100% of the time, because ultimately you will win 7 out of 10 times if you think that the odds are 70-30. Sometimes it's more, sometimes it's less. But again, as a trader, you use the data you have to weigh out your odds, okay? And that's where asymmetric risk profile comes into play. When something has asymmetric upside potential, that means the upside potential, the upside gains, significantly outweigh the downside risks. And that's how I feel about so many growth stocks that have been getting beaten down. They can't go much lower, but they can definitely go a lot higher, okay? And again, you have to pick the good companies. This is a stock picker's market. This is really a trader's market, honestly, over an investor's market right now. I will plug the newsletter portfolio, which again, has been really experiencing a rejuvenation and rebirth over the past month, but we'll do that a little later. Let's talk about this right now. So again, this guy, Kolanovic, reputable trader. I agree with every point he made in this video. And he also finds growth stocks and small caps extremely undervalued. And again, from a historical perspective, they are undervalued. So PE ratio is a price to earnings ratio. These are the S&P 500, again, large cap index, mid cap index, and small cap index. Why am I bullish on small caps a lot more than large caps? And again, I do think the S&P can bounce. I do think the NASDAQ can bounce. But when it comes to an actual truly undervalued perspective, like what companies would I buy and just hold for the long term, they're all small caps. And again, I'm trading these as well, but small caps, as you can see here, ARK Innovation, which we've covered in the past as well, is a good example of this. ARK Innovation, which is small caps, again, innovation ETF. They're focusing on world-changing companies, biotechs, again, cryptocurrencies, fintech, financial technology, et cetera, green energy. You guys all, I'm not going to keep ranting that, but you guys know what I'm talking about. Small caps have just gotten overly beaten up and are historically at very, very low levels when it comes to the price to earnings ratio, which is the historical indicator or historical benchmark that most investors and analysts look at when determining the fair value of a company. Right now, we are sitting the S&P 600 small cap index at a 12.2 as of June 1st, the date of recording. 12.2, which is crazy to think that back in 2020, this thing got up to almost a 28, so 27 just about 2 years ago. But since then, we have reverted to the pandemic level lows. And again, you look at just ARK Innovation ETF by Cathy Woods, ARKK on the charts. It's pretty much at pandemic level lows, which just doesn't make any sense, okay? That cannot be fundamentally justified given all, and again, you guys, my job is to look at the macros. My job is pretty much a macro analyst. That's a trader and macro analyst. Because that's how I do dictate a lot of my trades. Is again, the more data sets you have available to you and the more data sets you research and are aware of, the better you can weigh your odds and skew the odds in your favor with that knowledge, okay? So anyway, small cap index, you can see here at a 12, pretty historical low. It's very, very rare that we've spent much time below this level in the past. The only other times were in 08 during the financial crisis, which go watch my the video. The thumbnail has a bubble on it. This is not 2008 or 2001. These are different. They're the underlying fundamentals and the macroeconomic backdrop is just significantly different. With the argument that it favors the upside and it favors not kind of irrational behavior, and that again, this market is oversold. So go watch that if you haven't. But again, we haven't spent much time below this level. And I do think that we will recover to what is historically reasonable. And again, a reversion to the mean. That's a consistent theme that we've been talking about a lot lately. The reversion to the mean, which I do think will come into play around 15 is for small caps. It's actually a little higher. It's probably like 16 to 18 around here, but 15 I do think can happen. And once again, we are currently sitting at just above a 12, so that is some significant upside potential in that reversion. While once again, the S&P large cap index is sitting at a 17.5, and the mid caps are at 12.6. So mid caps, small caps definitely have some mean reversion to address. Okay, so that's that. Let's read over this. So on that note of being fearful, Trusty Fear and Greed Index was at a 25, almost reclaiming levels of general fear. Won't cover that, but let's talk about why this fear is where it is in the moment. And again, just these headlines and Mr. Jamie Dimon giving his bearish sentiment that contributes to this. So it's not surprising that investors are still feeling uncertain, considering the media continues to barrage them with headlines that virtually guarantee a recession. Jamie Dimon famed CEO of JP Morgan Chase, is on the front page of every site that covers the markets following some statements he made regarding his bearish outlook. Is there an economic hurricane looming? Most likely. But I mean, come on. This is what nearly every analyst on the planet has been saying for the past few months. This is nothing new. It's definitely a clickable and thought-provoking headline, though. Today's market is hyper-efficient at pricing in future economic complications, and I believe that at this moment, the majority of those potential economic complications have already been priced in. Okay, so we covered this a few days ago. I've decided that we'll start frequenting this indicator in the newsletter as well. The bull-bear index remains in oversold territory. Extremes on either end of the spectrum are unsustainable. And once again, this applies to so many meters. Bull bear indicator. Extreme greed is not sustainable, but neither is extreme fear. Okay. You want that middle ground for a healthy market environment, for honestly a boring market environment, which would be nice to get back to. And especially in this case, because I'm long growth stocks, I do think we need to get back into, it's okay to be a little fearful, but back into this fearful / neutral territory. Okay. Again, mean reversion, finding normalcy, which also applies to the bull bear index. So again, we're currently sitting below 1. Every time we've seen this in the past, which is 2008, you can see these pink areas right here, it's unsustainable. We typically see a bounce to 1.5 prior to another move further down. So again, you guys, do I think the downside is over? No. Especially for the S&P. Growth stocks, maybe, honestly, I do think capital will flow from large caps into small caps. And those two from, well, again, the S&P, the large caps, which are at like 18, and these are at 12, maybe they'll both meet in the middle at 15 because capital will flow from large caps, from the whale stocks, into smaller caps that have been oversold. But anyway, again, you guys, when you look at this, we are in an extreme. We're below 1 on the bull-bear ratio. And it's very, very rare that we spent much time below these levels in the past, okay? So I do think that there is some mean reversion. Again, can we go lower? We did see it back in, we've seen it multiple times in the past where we have gone lower than this, below 1, down to like a 0.5. Right now, we're probably at like a 0.6, 0.7, but we can go lower. Do I think it's likely in the near future before a bounce? No. Do I think we'll see a bounce? Again, mean reversion to like 1.5, reversion to that mean before another leg down. In the case that we do see another leg down, I think that is very, very likely. Okay, so plug time. In the case that you do want one of my newsletters, again, put 4 or 5 hours every single morning into writing these bad boys. I put a lot of work into it, okay? I feel it's very worth it. I do my best to provide you guys value. You can see in part 2, this newsletter right here is only one of the 3 newsletters that I send out every single trading day, okay? And then part 2, you can see here, where I also talked about, again, growth stocks and like the balance there. Just a little bonus here. After market close, throw in some real-time price targets and charts on all my favorite plays, on the plays that I think are most relevant to the portfolio. And then the first, of course, is my trade alert. So 3 newsletters every day. Along with those, you also get a complete breakdown of my entire personal portfolio, the Waves portfolio, which I update every single trading day during market hours. Again, a list of every single trade I'm making, all call options, all put options, all stock positions, all crypto positions, updated every trading day with the trades, why I'm making the trades, explain my trades in the Trade Alert newsletter, then go on to write my macro newsletter covering all the macro, and then lastly, again, the charts and stuff as well. So if you guys want this, again, pay it in the month of May. This would have paid itself over many, many times. In the case that it actually, regardless of how much you were trading with, this would have paid itself over for a very long time. So $15 a month, $40 for every 3 months. You be the judge of whether it's for you or not. That link is the first down in the description box below. And yeah, appreciate it if you check that out. If not, it's no skin off my back. Appreciate you watching right here, right now. So let's close out the video by covering this video. Barry Ritholtz, are we in a recession? Okay. Are we heading into a recession? According to a few observers, this is almost no longer a question, but rather seems to be fait accompli. So that's what I like. The fact that what a pretentious thing to say, honestly. But I get what he's saying. That means it's pretty much like it's already written. It's already in the cards. It's inevitable. Okay, that would have made sense. It seems to be inevitable. As a reminder, the official NBER's definition states that, quote, a recession involves a significant decline in economic activity that is spread across the economy and lasts more than a few months. Specifically, the criteria include depth, diffusion, and duration, none of which is present today. Given the economic data, it is startling, if not foolish, to state we are in a recession right now. As noted, low unemployment, continued job growth, and other signs of economic health make that timing moot. Second, because the economy is cyclical. It means that a recession is always coming. It's called a business cycle for a reason. The key here is timing. Is a recession imminent? I think not. Not in this quarter or the third quarter. I'm doubtful even the fourth quarter of 2022. Possible, but improbable. Why? Because most of the leading indicia, right there, indicators, indicia of economic contractions are not present today. Inflation remains a concern, and the biggest warning sign is the stock market. Year to date, the S&P 500 is off 13.3% and fell nearly 20% from its all-time highs, but neither of those are determinative. As my colleague Ben Carlson points out, bear markets can occur outside of recession, and they tend to be shallower and less lengthy, while recessionary bears are greater in both. Instead, consider the chart above via Matt Luzetti of Deutsche Bank. Good old Deutsche Bank. DB. It shows the Federal Reserve Bank of Philadelphia's monthly state coincident indexes. I cherry-picked this chart because it's of its good historical track record of showing a drop before recessions, and because by its nature it includes diffusion, 50 states, and duration, time series, that is two of the three NVR contraction factors. When we do a compare and contrast of 2022 with each of the 6 prior recessions going back 43 years to 1979, we see none of the early signs of contractions in any of the 50 states. This data series has shown an early warning that recessions were increasingly probable, but the state-by-state slowings took several quarters or even years to develop. Instead of 50 states showing expansion before recessions, that dropped to 45, 40, then 35 before the recession began, and the number of expanding states fell to 10, 5, or 0. The current monthly coincident state index shows all 50 states economically expanded. That not only makes it impossible for us to be in a recession today, but also makes it highly unlikely we'll be in a recession anytime soon. So again, you guys can take a look at this right now. We'll close it out there, you guys. Free. You can pause it on this chart if you want, but I hope that's some of these arguments shed some light on whether or some clarity if you're on the fence about being bullish or bearish right now. You obviously know where I lean. I'm an optimist, but again, with all of the data available to me, with all of the data that I consume on a daily basis, it seems more likely than not that in the short term, again, talking at least over the next couple of weeks, more upside, more relief is likely. And again, if you want to know how I'm trading that, where my money is, where my mouth is, my mouth where my money is, again, first link down below. And again, let me know in the description box, or let me know in the comment section down below as well. Do you still think a recession's coming, and why? Or are you investing right now, and are you ready to make some great trades? Okay, so I'll see you guys downstairs in the comments. These shades are sticking around for a while. Until next time, always remember, take action, make waves. Peace, guys.